Hello everyone, welcome to Oliveboard. I am Anshul, your CAIIB mentor, and today we are starting a whole new series for your complete revision of the BRBL paper. Your exam is very close, so it is important that you do not waste your time and devote your efforts towards revision. So, in this series, we are going to cover one whole module in one video. So, in this video, you are going to get all the units of your module A. So you need not worry about where to look for the revision. Simply watch these videos and all your concepts will be clear. So let us start with the first unit of Module A. So we start with the first unit of Module A, which is Legal Framework of Regulation of Banks. So the foremost section is the Section 5B of the Banking Regulation Act, which tells us the definition of banking. It gives us the basic definition of banking. And this definition contains certain terms which are very important, and 4 to 5 questions can be framed based on this. First, we have the Banking Regulation Act of 1949 and Section 5B. So banking under this means the accepting for the purpose for lending or investing of deposits. Accepting of what? Deposits of money. It is clearly mentioned that the bank is going to accept deposit only of money, not of any other tangible good. All right, so accepting the deposit of money for what purpose? For either lending or investing, and between this lending and investing and the deposits, the bank earns its income, which is the interest, right? So the bank will accept the deposits in the form of money for lending or investing, and this money is accepted from the public. Another point. All right, so first we have the accepting purpose, lending or investment. What? Accepting what? Deposits of money. From whom? The public. And the characteristic of this deposit is that it is repayable on demand or otherwise, and withdrawable by check, draft, order, or otherwise. So we have found here 6 terms in this one particular definition that has been provided. So section 5B tells us that banking will be the activity in which the banks are going to accept the deposits in the form of money from the public, and these deposits are going to be withdrawable. These are repayable on demand, and doesn't matter if the public they want to withdraw it by check or a draft or an order or any other way, right? And these deposits will be used for lending or investment. This is the whole definition of banking as given in section 5B. Many important questions can be framed from this definition. Then another important section is the section 49A, which talks about the rights that the banking company has. Now, the why banking company? Because it is registered under the Companies Act. All right. So the Banking Regulation Act, Section 49A says that no other person other than the banking company, the Reserve Bank of India, the State Bank of India, or any other banking institution, firm, or person notified by the central government is authorized to accept deposits which are withdrawable by check. All right. So now this section 49A is putting some restrictions on the banking activity. This banking activity of accepting deposits which are withdrawable by check can be accepted only by the authorized banking company, central bank, state bank, or any other institution which is notified by the central government. Now you might ask me that why are we not talking about the NBFCs, the non-banking financial companies, because they do accept deposits, but these deposits are not withdrawable by check. All right, so when we read the definition of NBFCs or the functions or the activities performed by them, we know that they accept deposits, but these are not withdrawable by check. All right, so this restriction has been put. So it is the section 49A. The questions can come from sections, at least 4 to 5 questions they are asked from sections. So very important that you at least note these sections down. So right now we have two sections, 5B and section 49A. Then we have section 22 of the Banking Regulation Act, which tells us that it is necessary for the banking company to have a license from Reserve Bank, from the central bank. Only then these firms, these banks, they can commence or start carry on the business of banking. So first they require a license from the central bank, and then they can carry on the banking activities as per the section 22 of our regulation. All right. So moreover, the section 7, another very important section, tells us that only after the banking company they have received the license from RBI will check the working capital, the rules and regulations, and other norms and guidelines, and then they will give on the license. And once they have got the license, only then they can use the words bank, banker, or banking as part of its name. And no company other than the banking company can use these words. So every banking company has the right as well as the obligation. They have to use the word bank as part of its name. This is given in section 7. And apart from these banking company who have received the license from RBI, no other company can use the words bank, banker, banking as a part of its name. Alright, so this is given in section 7. Then if we talk about the subsidiaries of the banks, associations of banks, primary credit societies, cooperative societies that are formed, right? They are given an exemption from this restriction. So again, exemptions are there to every section. So exemptions are also there to section 7. Exemptions which refer to the subsidiary of the bank or any other primary credit society, right? Then we have certain activities which are permitted to the banking companies. The permitted activities are given in the section 6(1). But what is important for us is the section 8. Section 8 that talks about the prohibited business. The prohibited business. We have already discussed that the permitted activities, including some of the activities which are permitted under section 1 apart from the accepting of deposit, giving out loans, is that they can include in dealing of bills of exchange, including drawing, accepting, selling, lending, advancing. They can also act for the managing, selling, right, realizing any property. But there are certain activities which are prohibited. What are these activities? A banking company is prohibited from engaging directly or indirectly in trading activities and undertaking any trading risk. So what does this trading activity mean? It means the buying or selling or bartering of goods directly or indirectly. Now I'm not talking about the security or collateral or selling of the security in case of the NPA. No, directly the banks cannot engage in the buying and selling of any goods. They cannot undertake the trading risk. So this is a prohibited business given in section 8 of the Banking Regulation Act. Then here the structure of banks is given to us, right? Under the central bank, there are the public sector banks, then we have the State Bank of India, we have RRBs, private sector banks, cooperative banks. So the public sector banks are governed under various statutes, laws, like they're constituted under the Banking Companies Acquisition and Transfer of Undertakings Act, the Banking Companies Act of 1980. Then if we talk about SBI, the State Bank of India, it is formed under the SBI Act of 1955. The various 7 subsidiaries which were earlier existing, they were merged later on, right? Then if we talk about the RRBs, the regional rural banks, again the RRB Act of 1976. All of these things are important, but all of these things are the basic concepts that we already know, right? So the RRB Act of 1976. Then the private sector banks and the foreign sector banks also entered the arena of banking in India, right? So most of the private sector banks, including the micro and the SFBs, these are companies again constituted under the Companies Act of either 1956 or 2013. Then cooperative banks also play a very important role with the enactment of the Cooperative Societies Act of 1904, right? We have the structure of cooperative banks, in which we have the urban cooperatives, the rural cooperatives. Under the urban, we have the scheduled urban cooperative banks and the non-scheduled. Then we have the rural cooperatives, long term and short term, right? All of these concepts are there under this particular topic. Then if we move on to the Reserve Bank of India. First act is the Banking Regulation Act, which talks about the various activities, the licensing, the sections, everything about the management and regulation of the banks. Now, if we talk about the Reserve Bank of India, it is the central bank. It was established by the Reserve Bank of India Act 1904. It was enacted to constitute the RBI of India, and it came into force from 6th March 1934. All right, so the Reserve Bank of India Act 1934, again, very important. Why does the central bank, or what are the functions of the central bank? Basically, to regulate the issue of banknotes, keeping the reserves with a view to securing monetary stability in India, generally to operate the currency and credit system of the country to its advantage. So the RBI acting as the central bank. It is the apex bank of India, under which the various banks they operate. RBI from time to time gives various guidelines and various laws and norms as to how the banking system will operate in India, right? So these guidelines are to be followed by the banks. Again, there are various sections under the RBI Act. Okay, so first is when we talk about the second schedule, again, a very important part of the RBI Act. The second schedule, it includes only those banks that satisfy the certain criteria mentioned in the section 42 of the statute. Section 42 talks about the criteria that the banks have to follow. Once they follow all of that criteria, or they satisfy the terms and conditions, then they are included in the second schedule, and we know then they are called as the scheduled banks, right? So section 42, which talks about the cash reserve ratios which are to be maintained, right? For the regulating of the credit system, for the monetary stability. Then also we have the criteria which includes the working capital and so on. All right. Then, so this is the section 42, which talks about the criteria, or the, we'll say, the structure of the banks that have to be followed to be known as the scheduled banks. There are certain other important sections in the RBI Act, like what do we have? We have the establishment and incorporation given in section 3, then capital requirement given in section 4, management is given in section 7, composition of the central board and term of office of the directors is given in section 8. So if we talk about the central board of RBI, the Central Board of Directors will constitute first the governor of the RBI and not more than 4 deputy governors. These deputy governors are appointed by the central government. Apart from that, we will also have 4 directors which are nominated by the central government. Then we have certain directors that are nominated by the central government. These are 10 directors, and 2 government officials are again nominated by the central government. These constitute the Central Board of Directors. So it is given under which section? Section 8. Then the business which RBI may transact is given in section 17, and which it cannot transact is given in section 19. The right to issue bank notes is given in section 22. The power of the central government to supersede the central board is given in section 30. So we will see this in further slides, that the central government has the right to give order to the RBI. Why? Because central government has to maintain the fiscal policy, and RBI has been given the power to regulate the monetary policy, right? So in certain case, the central government might find that the inflation is very high, or it might say that the market is going very slow. So it may give order or directions to RBI to accordingly adjust the money supply in the economy. The money supply can be regulated by various qualitative and quantitative measures. Quantitative measures are mostly used by RBI, like the cash reserve ratio, the statutory liquidity ratio, and so on. So RBI will increase or decrease the ratios accordingly if it wants to decrease or increase the inflation in the economy. So this is given in section 30. Then the requirement for maintenance of the cash reserves of the scheduled banks with the RBI. So every scheduled bank which is mentioned in the second schedule, they have to maintain certain cash reserves with RBI. It is given under which section? Section 42. So make sure that you are making small notes. You are noting these sections down because these are important. And once you have made notes, it will be very easy for you to revise before your examination. So just note these things down which I am mentioning as important. Alright, so these sections are the important sections. Then, like I said, RBI has been given certain powers and certain functions that it needs to perform. First, RBI is going to act as the banker's bank. Every bank creates a deposit with RBI in which it needs to maintain the cash reserves. Then RBI is the whole sole authority which can issue currency. Here we are talking about the notes, the currency notes. So RBI is the issuer of currency. Then monetary authority, it is going to control the money supply in the economy. It can increase or decrease the money supply. Deficit financing is the term. Deficit financing, which refers to the printing of new currency. Then it is also the regulator of the financial system, the manager of the foreign exchange. So the foreign exchange reserves are maintained by RBI. Then detection of fake currency, banker to the government, advisors are given, banker and advisor to the government. RBI is going to maintain the accounts of the government. If the government falls short of funds, then they can take loan from RBI, right? Or the government might say that please RBI, we are in the need, print more currency. So they act as a banker of the government as well. Then it is the regulator of the payment and the settlement in the economy. Also, it has certain development functions like the priority sector lending norms. So RBI gives out various directions as to how much priority sector lending should go to the MSME, or it should go to the weaker sections, or any other case, right? So these are the various functions which are performed by RBI. So RBI acts as the lender of last resort. Like when the bank is in the need, it can take loans from RBI. Or when the government is in the case, they are facing a risky situation, they can take loan. The banks can, in the situation of bankruptcy, they can resort to the RBI for help, for loans, right? Then um, what else is there for the functions of NBFCs? So the financial issues which are faced by NBFCs, various amendments are made by RBI for their regulation as well. Like the limit of the net owned funds has been enhanced. Then there are certain sections which have been included in the RBI Act, like the 45, section 45 ID. So section 45, which again talks about how the management of NBFCs will be done for the management of a regulated NBFC, right? Then what else? Various other sections which gives RBI to remove or debar an auditor or inspecting the books of account of the NBFCs. These things are there. Basically, section 45 has been amended, has been included in the RBI Act for the betterment of the NBFCs. All right. Then, what else is there? Okay, now we talked about section 7A. Section 7A says that the government of India has been conferred with powers to give directions to RBI whenever considered as important in the public interest in consultation with the governor of RBI. So, section 7 of the RBI Act says that although RBI is the whole sole monetary authority of the nation, it is controlling the money supply, the financial system. Still, if the government of India feels that there is certain need, then they can give directions to RBI for performing certain activities. All right. So they can directly or indirectly they can regulate or ask the RBI to perform a function, but these powers are supposed to be rarely used. And it was reported that the first and only time that these powers under Section 7(1) of the RBI Act was utilized by the government. So this becomes very important from exam point of view. Only once have these powers under Section 7(1) been used by the government of India in the whole history of India, that has been in October 2018, when separate letters were sent to the RBI governor giving directions on issues ranging from the liquidity for NBFCs, the capital requirement for the weak banks, and the lending to the SMEs. So these powers which are conferred to the government of India under Section 7(1) of the RBI Act have been used only once, and for the first time they were used by the government of India in October 2018. So we will remember these three issues for which the government gave directions to RBI: for the liquidity of NBFCs, the capital requirement for weak banks, and the lending to MSMEs. Now, what powers does the government have so that they can regulate or supervise the banks? For the appeal against removal of the managerial personnel, or regarding the cancellation of the banking license which is given under Section 22, or the refusal of the certificate for the any case or any preferred by the aggrieved bank with the government. Then suspension of the operations, exemption from any of the provisions of the Banking Regulation Act. These are the powers which are conferred with the central government. All right. So this is given under Section 7(1). Right. So now when we are talking about the RBI's role, another thing that I would like to repeat is that RBI is the central bank. It is the regulator of the non-banking financial institutions as well. Apart from the bank, the non-banking financial institutions are also regulated by RBI, right? So Section 3 of the RBI Act for taking over the management of the currency from the central government, carrying on with the business of banking in accordance with the provision of the Act. This is given in Section 3 of the RBI Act. So regulating the issue of bank notes, keeping of the reserves for ensuring monetary stability, to operate the currency and credit system of the country. All of these are the functions which are performed by RBI, acting as the regulator. And it also acts as the regulator of the other financial institutions like the NBFCs. All right. So NBFCs. So RBI as the regulator has various powers like the power to issue banking licenses, appointment and removal of the banking boards or personnel, power to regulate the business of banks, power to give out directions, inspect and supervise the banks, auditing, conducting the audit of banks, power to collect, collate, furnish the credit information, and relating to the moratorium, amalgamation, winding up, and the power to impose penalties. Now, we are going to discuss about the regulation of the NBFCs in detail when we discuss the unit 6 of this module, which talks about separately the non-banking financial companies. All right. Now let us start with the discussion of our unit 2, which is control over organization of banks. All right. So this module A completely talks about, we have already discussed two main sections, the Banking Regulation Act and the RBI Act, and the main provisions under it. So the provisions under these two acts that define the control over organization of banks, the organization, the whole management, the composition, we'll talk about the paid up capital, everything. All right. So control over organization of banks. The first important section under this is the section 22 subsection 3 of the Banking Regulation Act, which talks about the licensing. So we have already discussed that every bank, every company, when they wants to function as a bank, they need to get a license from the RBI. So before granting any license under this section, the Reserve Bank may require to be satisfied by an inspection of the books of the company or otherwise. So here we are talking about the inspection that RBI will undertake, the inspection of the various books, whether the company is in a position, do they have the required paid up capital, do they have the minimum requirements to be given the license. And only when it is satisfied, then it will grant a license. Also, this license can be revoked. RBI can cancel the license if it finds that the company or the bank, they are not working according to the given prudential guidelines or any other norms. We will see about the cancellation section also in the further slides. Now, when we talk about the foreign banks, so when foreign banks, they want to apply to the RBI for the license for the setting up of their WOS or branches in India, then also they need to satisfy that the prudential supervision in their home country. They need to give the necessary documentation, or RBI will inspect their books of records or other inspections as required to be satisfied that they're working, they are adequately following the prudential supervision in their home country. So a foreign bank, before they get the license, they need to provide this information, or they need to prove that they are working according to the required norms. Then if we talk about the private sector, then on 1st 2016 August, after consideration of all the comments, feedbacks, the guidelines named, the guidelines for on-tap licensing of universal banks. Now, universal banks today play a very important role. We already know this. In the private sector, if they want to get the licensing, there were various committees that were set up, various suggestions were taken for the committees, but then the final guidelines, or the final, we'll say, paper that worked out the licensing for the universal banks, this was in 2016. In 2000, subsidy or branch in India, the financial soundness of the foreign bank, the ownership pattern of the foreign bank, the rating of the foreign bank by any international rating agencies, and so on. So not only this, but various other conditions, criteria will also be seen by RBI. Then when we talk about universal banks, so the universal banks, the criteria will be the eligibility of the promoters, then the fit and proper criteria under the various scenarios, the regulatory framework, the pattern of shareholding, what is the business plan for the bank, all of these things will be seen. All right. Then if we move on to the small finance banks. So the small finance banks shall be registered as the public limited company under the Companies Act of 2013. So very important, if a question if a question is asked by the institution that under which act or under which category the small finance banks will be registered, so it will be registered as a public limited company and under the Companies Act of 2013. Again, when we talk about the small finance banks, so for them the same guidelines in respect of the registration, licensing, regulation, what is the objective of setting up the small finance bank, then the eligibility criteria of the promoters, the scope of activities, capital requirement, corporate governance, if in the future they want to move into or they want to transition into a universal bank, all of these things will be there. Now, I told you that apart from licensing, the RBI also has the power to cancel a license of a banking company, right? So, the RBI has powers to cancel a license of a banking company. It is derived from the subsection 4 of the section 22. So section 22 subsection 4 of the Banking Regulation Act. So when can RBI cancel the license of a banking company? First reason can be if a company ceases to carry on the banking business in India. They are no more accepting deposits or giving out loans, then the license will be cancelled. Second is if the company at any time fails to comply with any of the conditions that are imposed upon it under subsection 1. So section 22 subsection 1 tells us the conditions that the banking companies need to follow at all times. If they fail to comply, then also RBI can cancel the license. And if at any time any of the conditions referred to in subsection 3 or subsection 3A is not fulfilled. So when we talk about these conditions, when we are talking about if any of the conditions are not fulfilled, then RBI, according to their observation, their investigation, they can cancel out the license. All right. Then what else? Which, okay. Then if we have for opening places of business, if a bank wants to open up a branch in any of the district, city or state in India, then this is under the section 23 of the Banking Regulation Act. Another very important section, section 23. This says that without obtaining the prior permission of the Reserve Bank. So it is important to get the prior permission of Reserve Bank. Only then the banking company can open a new place of business in India or change otherwise than within the same city, town or village the location of an existing place of business. So if a bank branch is located in, let's say, Lucknow, and the banking company wants to shift it to another district, another town, another village, another city, or they want to set up a new branch, then they need to obtain prior approval of RBI. Then no banking company incorporated in India shall open a new place of business outside India or change otherwise the location of the existing place. All right. So neither inside India nor outside India can a banking company open a new place of business without obtaining the prior approval from RBI, right? And when RBI is giving the permission under this section, then they may require to be satisfied with the inspection or the financial condition and history of the company. Then they may grant the permission subject to the conditions that are referred in this particular case, right? And wherever RBI feels they're of the opinion that the banking company has failed to comply, then they can also cancel, they can reject the application, or they can revoke the license as well. All right, so the place of business can refer to any sub office, any pay office, any place where the deposits are received, where the checks are cashed or money is lent, and so on. All right, then next we talk about the paid up capital. What is the minimum paid up capital which is required by the different types of banks? First, we have the foreign banks. So this is given under section 1 subsection 2 of the Banking Regulation Act, that a foreign bank, which is a banking company incorporated outside India and it has opened a wholly owned subsidiary or branch, then it has to deposit and keep deposited with the Reserve Bank an amount of rupees 15 lakh if it has a place of business in Mumbai or Kolkata or both. All right. So here we are talking about when a foreign bank wants to open a place of business in Mumbai or Calcutta or both, then they have to deposit a rupees of wherever they're operating in India, any place in India, then an amount of 15 lakh. And if it has a place of a business in Mumbai or Kolkata or both, then rupees 20 lakh. These two things are there for the paid up capital and reserves of the foreign bank, right? Then if we talk about the Indian banks, so in case of the banking companies incorporated in India, what is the requirement of the minimum paid up capital? First, if it has places of business in more than one state, if they have the office or where the checks can be deposited or anything, then these offices are there in more than one state, then 5 lakh of rupees. And if any such place or place of business is situated in the city of Bombay or Calcutta or both, then 10 lakhs of rupees. So if they want to operate, if they have a place of business in more than one state, then 5 lakh, and if these state include Bombay and Calcutta, then 10 lakh. Second condition is if it has all its places of business in one state and none of which are situated in Bombay or Calcutta, then 1 lakh of rupees in respect of its principal place of business plus 10,000 rupees in respect of each of its other place of business situated in the same district. So this condition is where only one state the bank is operating. Only one state. And that state is not Bombay or Calcutta. And this situation was more than one state, and the place of business is in the city of Bombay and Calcutta. Alright, so these are the minimum paid up capital and reserves requirement for the Indian banks as stipulated under the Banking Regulation Act, Section 11. So, Section 11 talks about the paid up capital and reserves. Alright. Then we have another important section, that is Section 12. What does the Section 12 talk about? Section 12 tells us the voting rights, the shareholding in the banking companies. What will be the shareholding in the banking companies? First and foremost, there is no specified ceiling on a person's holding of shares, right, in a banking company, except for the 5% of the paid up capital, which is given under Section 12B. Apart from that, there is no specified ceiling on a person's shareholding in a banking company. Now, what does Section 12 talk about? So, the Section 12, subsection 2, tells us that no person holding shares in a banking company shall in respect of any shares that are held by him exercise voting rights on poll in excess of 10% of the total voting rights of all the shareholders. So doesn't matter how many shares you have of the banking company or what is your shareholding, but your voting rights will not exceed more than 10%. This has been given under the Section 12 of our Banking Regulation Act. Then if we talk about, obviously when any person is holding the shares, they are holding them for the income generation purpose, right? So this is given in the context of the payment of dividend. Right. So as per the guidelines of Reserve Bank, the banking companies will be eligible to declare dividends only when they comply with the minimum prudential requirements. So a banking company can declare dividends only when they follow these prudential requirements, which are: first, the proposed dividend should be payable out to the current year's net profit. All right, the dividend that they want to declare should be payable out of the current year's net profit. It should not be more than the net profit generated. Second, the bank should have the CRAR of at least 9% for the preceding two completed years and the accounted year for which it proposes to declare the dividend net NPA, and the net NPA is less than 7%. So when a banking company they comply with these prudential requirements, then they can declare the dividends. All right. Then if we talk about subsidiaries, the subsidiaries of banking companies, the formation of subsidiaries or shareholding in the other companies. So this is given under Section 19, that there are certain restrictions of the Banking Regulation Act on the formation of the subsidiaries of by the banking company. So Section 19 tells us that there are certain restrictions. This is for the purpose of preventing the banks from carrying out trading activities by acquiring a controlling interest in the non-banking companies. So shareholding in the companies. Apart from the restriction on the subsidiaries, there's also a ceiling on the shareholding in the companies that the banks can have other than the subsidiaries. Thus, the holding of these shares by a banking company in a company as a pledgee or a mortgagee or absolute owner shall not exceed at any time 30% of the paid up share capital. All right, this is also there. Then if we talk about another important section, which is Section 10, it talks about the board of directors. The board of directors given in Section 10. So Section 10A of the Banking Regulation Act stipulates certain qualifications for the directors of the banking companies. So when the directors of the banking companies are employed, they need to have certain qualifications. like at least 50% of the total number of directors. They should have special knowledge or practical experience with respect of accountancy, agriculture, rural economy, banking, economics, right? Further, at least two of the directors, they should have special or practical knowledge in agriculture and rural economy, or cooperation or small scale industry. So they should have the special and minimum qualifications. Only then they can be appointed as the directors. Then this is given in section 10A. Section 10B tells us that every banking company should have a whole time or part time chairman that is appointed from its directors. Now the whole time or part time chairman will also be appointed from these particular directors, right? So the chairman, if they are appointed on a whole time basis, then they are interested with the management of the entire affairs of the bank. And then on a part time basis, they will be appointed with prior approval of Reserve Bank, and it will be subject to the conditions that are imposed by the central bank, right? If in any case the chairman is absent, then the whole of the affairs of the banking company shall be entrusted to a managing director, to the MD. Now there are certain qualifications of the whole time chairman or the managing director, right? And these are given in section 10B of the subsection 4. Plus they should have the practical experience of working in a banking company. They should have financial, economic or business administration knowledge, right? These all conditions are given in section 10. Then okay, now RBI also has powers to appoint additional directors. RBI can also appoint additional directors. This power is given to RBI under section 36 AB of the Banking Regulation Act, right? Additional directors given under section 36. So if RBI is of the opinion that it is in the interest of the banking policy or public interest or in the interest of the banking company or its depositors, then it may from time to time by order in writing, they can appoint with effect certain additional directors, and they shall hold the office during the pleasure of the Reserve Bank, and this period should not exceed 3 years or any such period not exceeding as given by RBI, right? Then what else? This is given in section 36. There are also certain prohibitions, certain restrictions on the employment of managing agents. So this is given under the Banking Regulation Act section 10. This section prohibits the employment of managing agents and imposes restrictions on the employment of certain type of persons. So very it is very obvious that certain type of people cannot be appointed as the managing agents, like a person who has been declared as an insolvent or has suspended payment or has compounded with her or his creditors. Then any person who has been convicted by a criminal court of an offense involving a moral character. Then a person whose remuneration is by the way of commission or share in the profits, and if a person whose remuneration is in excess of the opinion of RBI, then these persons can be prohibited from employment as the managing directors. This is given under which section? Section 10. All right. Then under section 36 AA, RBI can also remove any chairman, any director or chief executive officer. So all of these powers have been given to RBI. Although the powers or the sections are a part of the Banking Regulation Act, still it is given to RBI. So it is very important that you remember. Do not get confused and say that no, this is under the RBI Act. It is very important that you remember these sections of the various acts, because sections, mostly questions that are based on sections are asked from Module A. So it is very important that you understand the difference. All right. So basically, these are the important sections that are covered in this particular chapter when we talk about the control over the banks. Then RBI has the power to control over management as well, that we just discussed under section 36 AA. They can remove any chairman, director or the chief executive. So RBI should be satisfied that it is necessary to do so, right? That it is in the public interest for preventing the affairs of banking company being conducted in a manner which is detrimental to the interest of the depositors, for securing proper management of the banking company. Now, obviously, the appeal will lie with the person who is being removed. They can appeal with the central government. So an appeal against the order of removal lies with whom? Lies with the central government, not with any court or tribunal, but directly with the central government. So such an appeal has to be filed within 30 days from the date of communication of the order, and then the appellate decision that is taken by the central government will be final, and it will not be liable to be challenged in any civil court later on. So decision of central government will be final. All right. Then there are certain other topics also which are covered in this chapter, but they are not of importance of our concern, right? So we have discussed the most important sections, and whenever you are reading this chapter, you are making your notes, make sure that you have a separate mark or column for the sections. So you should remember these sections. Section 10 talks about the prohibition of employment, or section 36 talks about additional directors. Then section 10A and 10B, certain qualifications of the directors, right? Section 19 talks about the subsidiary. Section 12 talks about it is important that no person has the voting right of more than 10%, no matter what is their shareholding. Then for the opening of a new place of business, what is the requirement? The foreign banks paid up capital given under which section? All of these things are very important. These sections are the important sections. Regulation of banking business. It basically talks about the various sections wherein the powers to issue directions are there with RBI. Then the regulations on the acceptance on deposit, nomination, loans and advances, and so on. So the regulation of banking business, first we have the section 21 and section 35A of the Act. Both of these Act authorize RBI to issue directions. RBI has the authority to issue directions to regulate the advances by the banking companies. So section 21 and section 35A is very important. The directions that are issued by the Reserve Bank in exercise of these two sections are statutory directions and are binding on the banks. Banks have to follow them. These are binding on the banks, right? So these are mandatory. Binding means that these are mandatory for the banks to follow, right? So this is very important that you remember. The question can be asked that what is the nature of the directions that are issued by RBI under section 21 and 35A. So these are statutory directions which are binding on the banks. So RBI has statutory powers to give such instructions to the banks. All right. Next we have the returns on unclaimed deposits. So definitely there are some unclaimed deposits at the end of the calendar year. So what do the banks do in case of that? So banks have to file a return every year on their unclaimed deposits under section 26 of the Banking Regulation Act. And another important thing, the return has to be filed within 30 days of the end of each calendar year in the form and manner that is prescribed. And it should cover all the deposits that have not been operated for 10 years. So unclaimed deposits, those accounts that have not been operated by the account holder for 10 years, they are considered as the unclaimed deposits, right? Then under section 26 it says that the banks have to file return on those unclaimed deposits within the 30 days of the next calendar year, of the end of each calendar year. All right. So any of these deposits, whether we are talking about the savings bank deposit account, fixed or term deposit, cumulative or recurring deposit, current deposit, cash credit accounts, any loan account, margin money, anything. So any amount which is payable in foreign currency also, which has remained unclaimed, will be considered. Will be considered. Then if we talk about the payment of deposits. So a depositor or depositors of a banking company, which term includes a cooperative bank also, is empowered by section 45ZA of the Banking Regulation Act to nominate one person in manner prescribed. So here we are talking about nomination, right? So every depositor has the right to appoint a nominee. This nominee would be the person that is entitled to all the rights of the depositors and to whom the amount comprising of the deposit would be returned in the event of death of the sole depositor. So this is the nomination. And obviously we have studied about nomination. It can be varied or it can be cancelled at any time by the depositors, right? Then the case where the nominee is a minor or anything, all of these things are there in the details. But under section 45ZA, the nomination can be made. Then in the case of safe custody and safety lockers also, the nomination facility is available. It is given under which sections? Section 45ZC and Section 45ZE. This provides that if any person who leaves any article in the safe custody and in the safe deposit lockers with a banking company, they may nominate one person as a nominee to receive the article in the event of death. Again, the bank has to make sure that this nominee, they do not face any problem after the death of the account holder of the or the safe deposit holder, and without any problem the articles are returned to them, right? So in that case, the exercise of due care and caution should be done to identify the survivors or nominees identity, right, and the fact of the death of the locker hirer. Then diligent effort to find out if there is order or direction from the court restraining it from giving access to the locker, and the access to the articles in the locker or the safe custody is given to the nominee only as a trustee of the legal hire of the deceased locker hirer. All of these things are there in detail. We need to remember these sections. Then there are, when we talk about the loans and advances, when the banks are given out certain loans, the definition includes that bank's purpose is creating deposits, giving out loans. So RBI again has authority to control the loans and advances in public interest, in interest of the depositors, the purpose for which the advances may or may not be made, the margins to be maintained, the maximum amount of advances, then the rate of interest, other terms and conditions, all of these things, right? Now there are certain restrictions on the loans and advances. These are there under section 20 of the Banking Regulation Act. These restrictions are that no banking company shall grant loans or advances on the security of its own shares. First point, the banks cannot grant loans on security. The security that the person keeps for the loan cannot be the bank's own shares. Second condition or second restriction is that a banking company is prohibited from entering into a commitment for granting loans or advances to or behalf of any of its directors. So the bank cannot grant loans against the own shares as securities, plus it cannot grant loans on behalf of any of its directors. These two restrictions are imposed and they are imposed under section 20. So these prohibitions or restrictions will apply to even the loans and advances made to firms in which any director is interested as a partner or manager, or any company in which the director holds substantial interest, right? So these things have to be checked. Then we have the restrictions on the power to remit debt. For remitting any debt to its directors, a banking company requires prior permission of the Reserve Bank, and this is given under section 20A. So it is a subsection of section 20. All right. Then if we talk about the interest rates on the loans and advances, we know earlier it was regulated, but now banks have flexibility to decide. So the interest rates on loans and advances is subject to the regulation which is specifically given under section 21 subsection 2E of the Banking Regulation Act, apart from the general provisions of section 35A. So both these sections, section 35A and section 21 subsection 2E, the interest rates on deposits are determined. The regulations are given for the interest rates on loans and advances. And RBI has been issuing these directions from time to time under Section 21 and Section 35. The lending rates, the freedom also is given to banks to decide the rates themselves. Only the margins, the maximum and the minimum, these types of directions are given. Then if we talk about the interest rate determination, we have to discuss the base rate, the marginal cost of fund based lending rates, the external benchmarks on which the interest rates are decided now, right? So first we have the base rate system. Earlier the BPLR system was working, then the base rate system replaced it, right? When was this system replaced? On July 1, 2010. And the base rate shall include all those elements of lending rates that are common across all the categories of borrowers. So the bank may choose any benchmark for arriving at the base rate, and it should be disclosed transparently, like what are the benchmarks that are used by the banks. Then they may determine their actual lending rate with reference to the base rate, right? Then we have the marginal cost of fund based lending rate, which was introduced by RBI on 1st April 2016. The bank cannot grant any loan below that rate except in certain cases. So it is the marginal cost of fund based lending rate. As the name suggests, it will include the marginal cost of funds, that is the marginal cost of borrowings and the returns on the net worth. Then the negative carry on the account of the CRR, the operating costs that are incurred, the tenor premium, all of these things will be included when calculating the MCLR. And this MCLR will be overnight or 1 month, 3 months, 6 month, 1 year. These MCLR rates are declared, right? So these are, we can say these are internal benchmarks, right? The internal benchmarks. Okay. Then finally, we have arrived at the external benchmark, the external benchmark based lending. So RBI, in its fifth bi-monthly monetary policy statement for the financial year 2018-19, under the Statement on Developmental and Regulatory Policies, dated December 5, 2018, stated that all new floating rate personal or retail loans and floating rate loans to the micro and small enterprises shall be linked to the external benchmark, and this is done from April 1, 2019. So all the loans that are made, whether on the new floating rate personal retail loans, floating rate loans to the micro and small enterprises, now external benchmarks will be used for deciding the interest rates. All right. And the banks are free to offer such external benchmarks that are and linked loans to other types of borrowers as well. Then the banks have to ensure transparency, standardization, and ease of understanding the loan products by the borrowers. So they must adopt a uniform external benchmark within a loan category, right? And the external benchmark, the rate of interest under the external benchmark will be reset at least once in 3 months. It has to be reset according to whatever benchmark, external benchmark has been selected, right? Then if we talk about the very important amendment, which is the Reserve Bank of India Amendment Act 2006. It empowers in public interest to regulate the financial system of the country to its advantage, to determine the policy relating to the interest rates or interest rate products, and give directions on behalf to all the agencies. So the question can be asked, which amendment act or which section was included that empowers RBI to act in public interest to regulate the financial system of the country or to regulate the interest rate, right? This will include dealing in securities, money market instruments, foreign exchange. So RBI is not controlling, but it has the power to regulate all of these functions in interest of the financial system of the country. So this was given in the Reserve Bank of India Amendment Act of 2006, right? So RBI's guidelines on the technology and security standards, the legal issues, technology standards like the information security officer and their responsibility, then logical access control techniques that the banks should introduce, physical access should be strictly enforced, right? Then uh, the backed up data should be periodically tested to ensure the recovery. All of these things come under the technological standards. Then legal issues, right? And that all the account opening requests that are received over internet should be opened only after proper physical verification of the identity. Other things like risk control measures have to be adopted to manage any risk that is occurring. Regulatory and supervisory issues are given, right? So various things are there. The internal control system, disclosures issues, security features, and so on, right? Then RBI also has a regulation on the money market, call market, and everything. Then, if we talk about the Integrated Ombudsman Scheme 2011, very important, we'll be studying about this scheme in detail in another chapter. But here, for the convenience, it is mentioned that the scheme integrates the existing three ombudsman schemes of RBI: the Banking Ombudsman Scheme of 2006, the Ombudsman Scheme for Non-Banking Financial Companies 2018, and the Ombudsman Scheme for Digital Transactions 2019. So the earlier three Ombudsman schemes have been now integrated under one scheme. This is the Integrated Ombudsman Scheme of 2021. Apart from this, a very important thing that you need to remember is that it will include under its ambit the non-scheduled primary cooperative banks with a deposit size of rupees 50 crore and above. So all those non-scheduled primary cooperative banks that have a deposit size of rupees 50 crore and more than that, they will also be included under the integrated ombudsman scheme. We already know the grievance mechanism, the grievance redressal mechanism, the officer, how the complaint is to be made, in how many days the complaint can be given to the ombudsman, right? So all of these things are there. So the authority or the official which is appointed to receive and investigate any grievances against the institution or the agency or even the government, right? So this thing is there. What else? The existing schemes have been repealed, right? Because obviously they have been integrated. So the existing schemes, the three schemes have been, they stand repealed now, and it applies to the services which are provided by regulated entity in India to the customers under the provisions of the Reserve Bank of India Act. Then we have the role of the principal nodal officer. So the regulated entity shall appoint a principal nodal officer at their head office, and their rank should not be less than the general manager, right? We already know these basic things about the integrated ombudsman scheme, right? And they shall be responsible for representing the regulated entity, furnishing the information on behalf of the entity. Then we also have the Limitation Act of 1963 for such claims, that in how many days the complaint has to be given a solution, right? So these things are there. Then we have certain reserve funds that have to be maintained. We have the cash reserve ratio, the statutory liquidity ratio. So the cash reserve ratio, which is required to be maintained by a scheduled bank with the reserve bank, is given under section 42 subsection 1 of the RBI Act. All right, now the cash reserve is not given under the Banking Regulation Act but under the RBI Act, and it is the average daily balance being such percent of the total of the demand and time liabilities in India of that bank as shown in the return referred to in the subsection 2. All right, and again RBI from time to time it can decide, it can change, or it can modify the cash reserve. So a percentage of the daily balance of the demand and time liabilities that the bank has to keep with the central bank. with the central bank is the cash reserve ratio, and it is given under section 42(1). Then in case of the non-scheduled banks which are not covered, the cash reserve need not be maintained with the reserve bank. All right, this is very important. Only the scheduled banks are required to maintain this cash reserve with the central bank or with RBI. The non-scheduled banks do not need to maintain the cash reserve. Then if we talk about the statutory liquidity ratio, so this is a part of the total reserves that the bank has to maintain with themselves. Themselves. So if we want to remember CRR, C we will relate it to the central bank, that it has to be kept with RBI, and SLR we will relate it to self. SLR is the percentage that is maintained with the bank themselves. So every banking company has a duty to maintain certain percentage of their net demand and time liabilities as assets in India under section 24 of the Banking Regulation Act. Alright. So SLR is given under section 24 of the Banking Regulation Act in the form and manner that is specified by RBI. Then the minimum requirement has been provided under the Banking Regulation Amendment Ordinance 2007, which has amended the provisions of section 24, omitting section 1 and subsection 2. So now a minimum requirement of 25% has been given. So the statutory liquidity ratio minimum has been given, that at least 25% will be maintained, right? So what will be the quantum of the cash reserve, or how much cash reserve will be maintained? All of this is given by RBI from time to time, right? Then when we talk about the maintenance of the cash reserves, then they have to be reported to the Reserve Bank also. So there is a form A for the return of the scheduled commercial banks, the SFBs and the payment banks and the LABs. Then form B talks about the return for the scheduled cooperative banks, and form 1 talks about the return for the non-scheduled cooperative banks under section 18. So various things are there. We need not go into detail when we are studying the sections. Only we need to remember the important sections and what does they tell us about, right? Then what else is there? We have already seen that minimum 25% will be maintained as the statutory liquidity ratio, and obviously if there is any default by the banks, if they fail to maintain these reserves, then penalty will be paid. So if the balance on any alternate Friday falls below the minimum requirement, then the banking company will be liable to pay to the Reserve Bank a penal interest at the rate of 3%, right? So in the case of default, the penalty of interest of 3% above the bank rate on the shortfall for the day will be paid. And again, if the bank continues to make the default, if the default continues on the succeeding alternate Friday, then the penal interest rate will be raised to 5% above the bank rate, right? So this interest or this penalty has been imposed so that the banks at all times maintain the cash reserves. If they do not, they will have to pay the penal interest rates, right? Then when we talk about the assets, then again the quarterly position of assets is determined on the close of the business of the last Friday of every quarter, right? So this is also there under the provisions, and it is supervised by RBI. So I think these are the most important sections. Then we have another section, section 25 of the Banking Regulation Act. It states that the assets in India of every banking company at the close of the business on the last Friday of every quarter, or if that Friday is a public holiday under the NI Act, at the close of the business of the preceding day, shall not be less than 75% of its demand and time liabilities in India. So here we are talking about the assets in India. So what shall be the quarterly position of assets? It is given under which section? Section 25 of the Banking Regulation Act. It says that the assets should not be less than 75% of its demand and time liabilities in India. So every banking company, they have to submit to Reserve Bank a return in the prescribed form. This return will be submitted within 1 month from the end of every quarter, right? Of the report of the assets and the liabilities which are referred to in the subsection 1 of section 25 under this particular act, right? Also, the regional rural banks have to submit their report, but they will submit their report to NABARD, right? So assets and liabilities also are defined under section 25. This provision is there, or this provision is important. Why? So as to ensure that the resources that are mobilized by the banks, especially the foreign banks, are largely invested in India or largely invested within the country. So these assets may be in gold or in cash or any other approved security. It will also include the export bills which are drawn in and the import bills which are drawn out. So at any time when the report has is to be submitted to RBI, then the assets should not fall below 75% of the demand and time liability. So whatever liabilities are being generated, the assets that are made out of it should be 75%. Start with the unit 4 of our module A of BRBL paper. We have the unit 4, which is returns, inspection, winding up, mergers and acquisition. This is quite a lengthy chapter, but we have summarized, we have included the most important sections, the most important topics that are crucial from our exam point of view. Now let us start. All right, so this chapter basically talks about the various returns that the banking companies, foreign banks, the non-scheduled banks, they're required to make, right, under the Banking Regulation Act, right? So first we have all those banks who are listed with stock exchanges. They have their shares listed with stock exchanges. They're required to publish their unaudited quarterly results. So when we are studying this chapter, first we need to see the different types of returns, the section, and then when, at what time do they require to publish it. So those banks that have their shares listed with the stock exchanges, they're required to publish their unaudited quarterly results. So on a quarterly basis, as per the format that is prescribed by SEBI. Why SEBI? Because we are talking about the shares and the stock exchanges. And every banking company has to prepare its balance sheet, profit and loss account, which is stipulated in section 29 of the Banking Regulation Act. So when we talk about the financial statement, so the profit loss account, the balance sheet, other things that are included in it, everything will be prepared. Then when we talk about the foreign banks, right, their wholly owned subsidies or subsidiaries or the branches that are operating in India, they are incorporated outside India, right? They have to display in a conspicuous place in their principal office a copy of the last audited balance sheet and profit and loss account. So apart from the other returns that they are needed to provide, or they needed to submit, they also need to present this copy of their last audited balance sheet, right? So when we are talking about the banks whose shares are listed with the stock exchanges, the balance sheet and the profit and loss account, it has to be prepared at the end of each calendar year, or we'll say the expiry of the 12 months period, whatever is specified, right? Then the balance sheet and the profit and loss account of the banking company incorporated in India, it has to be signed by whom? The manager as well as the principal officer of the company, and at least three directors. All of this information is important. If there are more than three directors, right? And if there are less than three directors, then it has to be signed by all of them, right? If there are more than three directors, then at least three. And if there are not more than three directors, then all of them. By all the directors, it has to be signed, right? Then we also talked about the foreign banks, right? And that is there. Next, if we take the case of the functions, duties of the auditors and liabilities, penalties that they are subjected to, these are given under section 227 of which act? The Companies Act of 1956 or section 143 of the Companies Act 2013. It is applicable to the auditors of banking companies also. So who is going to conduct the audit? The audit and the auditors, The auditing of banks is given under which section? Section 30, subsection 1 of the Banking Regulation Act, that to conduct the sound and robust audit function in the respect of accounts of the bank, right? Then what are the powers and functions of the auditors, right? They need to see whether or not the information that has been provided, it is explained in a correct manner which is required, it is found to be satisfactory. Then whether the transactions of the company, they are given correctly or not, whether the returns that are made from the branches were adequate for the audit, profit and loss account, do they show the true picture, right? Any other matter that the auditor feels or they consider necessary to bring to the notice of the shareholders of the company, these are all the functions of the auditors, right? So, safeguarding the interest of the promoters, then responsibility towards the public, depositors, all the stakeholders, these are the responsibility of the auditors. Now, there's another important concept which is known as a special audit. This is given under Section 31B of the Banking Regulation Act. Section 30 talks about the audit, right? Then Section 30 subsection 1B talks about the power which is given to the Reserve Bank of India. RBI is empowered under this section to order a special audit of the accounts of any banking company. So when the central bank is of the opinion that special audit is necessary in the public interest or in the interest of the banking company or its depositors, and it is binding on the banking company, if RBI says that we need to conduct this audit, the banks, they cannot reject it, right? And all the expenses, this was asked in the previous year question as well, that all the expenses in relation to the special audit will have to be borne by whom? Borne by the banking company. So all the charges, all the expenses will come under the banking company. All right, this is regarding the special audit. Then what all returns have to be submitted? So return has to be given on the liquid assets. So every banking company has to submit a return on its liquid asset under which section? Section 24 subsection 3 of the Banking Regulation Act. And this return has to be submitted within 20 days from the end of the month to which it relates, right? So for every month, this return of the liquid asset has to be submitted and within 20 days from the end of the month. And this has to be according to the form which is prescribed under Rule 13A of the Banking Regulation Companies Rules of 1949. All right, so these sections are important. Section 24, subsection 3. So it should contain the particulars of the assets and the demand and time liabilities, right? And Reserve Bank can also ask the banking company to furnish returns showing particulars of certain assets at the close of each day of the month as well. Then we also have returns regarding the monthly, right? So monthly returns. This is given under section 27, that a banking company has to submit to the Reserve Bank a return under section 27 of the Banking Regulation Act, showing its assets and liabilities in India as at the close of its business, right? So on the last Friday of the previous month, that is the closing. So last Friday of the previous month, every month the banking company will have to submit this return. So it is a monthly return. All right. Then regarding the accounts and the balance sheet, annual accounts and balance sheets have to be submitted to the RBI within 3 months from the end of the period, right? Regarding the return of assets in India, regarding the unclaimed deposits that we'll be covering in other chapters as well, the return of cash reserve of the non-scheduled banks, all of these things are there. When we talk about the return of scheduled banks under section 42 of the RBI Act, the scheduled banks have to submit returns to the Reserve Bank of their demand and time liabilities, which is specified in the subsection 2. So section 42 talks about the returns that have to be submitted by the scheduled banks. Then if we talk about the preservation of records, the preservation of records and the return of the paid instruments, this is given under section 45Y of the Banking Regulation Act. that the central government may, after consultation with the Reserve Bank, make rules specifying the periods for which a banking company shall preserve its books, accounts, and other documents, and a banking company shall preserve and keep with itself different instruments that are paid by it. Like when we'll be talking about the Prevention of Money Laundering Act. So to ensure that the accounts are all the information is maintained, then for a certain period all the transactions above a certain limit will be maintained, the documents will be maintained, even after the closing of the account the documents will be maintained, right? We will study this in detail when we study the Prevention of Money Laundering Act in the next module, right? Then if we talk about the information that will be preserved, like the all cash transactions of the value more than rupees 10 lakhs or less than 10 lakhs, but in a particular month it accumulates to rupees 10 lakhs, non-profit organization value of rupees 10 lakhs. We'll see this in detail when we study the particular chapter. Regarding the return of the paid instruments as well, right? So again, section 45Z of the Banking Regulation Act, the bank is authorized to return the paid instruments to the customers even before the end of the period of the preservation which is specified under the act, right? Then if we talk about the special audit, right? The special audit which is given under the powers to RBI. RBI is empowered to conduct special audits. So for that, all right. Next we have the Board for Financial Supervision. So this was made the Department of the Banking Supervision, DBS. It empowers the RBI to inspect and supervise the commercial banks. This department was created by RBI, so RBI indirectly conducts the inspection and supervision. The Department of Banking Supervision was tasked with the inspection and surveillance functions relating to the commercial banks from 1993. Before 1993, separate departments were working for different areas, right? But now all the credit institutions, it includes the scheduled commercial banks, cooperative banks, local area banks, NBFCs, SFBs, everything. Before that, different departments were working. Like there was a different department for banking supervision, department for the non-banking supervision, then the department for cooperative banks was set up, right? These things were there. If we talk about the constitution and composition, again we have the details about this department in another chapter that we'll be covering there. Like the governor of the Reserve Bank of India is the chairman of the board, then there are the deputy governors who will be the members, then four directors are also nominated from the central board of RBI, right? So these things we'll be seeing in detail. But for the supervision, this department has been set up. Functions, again, for the supervisory process, off-site surveillance system, all of these are the common functions that we already know. Meetings, this board is required to meet normally once every month. So monthly meetings will be conducted by the department, right? Then if we talk about the Daksh portal or a new initiative that was launched. So this is the Reserve Bank's advanced supervisory monitoring system, right? So in 2022, RBI announced launch of a new initiative named Daksh. It is a web-based end-to-end workflow application through which RBI shall monitor the compliance requirements in a more focused manner with the objective of further improving the compliance culture in the supervised entities like the banks, NBFCs, etc. So it is a web-based digital solution, we'll say, right, for better compliance, better monitoring that all these regulated institutions are working according to the guidelines that are issued by RBI. So Daksh initiative, it is an important initiative that was taken by RBI. So it enables communication, inspection, planning, and execution. If there is any cyber incident, so reporting and analysis, management information system reports, right? Anytime, anywhere, secure access is provided. So this was for the inspection, audit, and so on. Then we have the acquisition of undertakings, right? We have the amalgamations, mergers, all of these options are there. Like, who has the power to make a scheme for the acquisition? So the central government is empowered to make a scheme for any acquired bank. Then such scheme is to be framed in consultation with the Reserve Bank. These are some things that we already know, right? So the central government can acquire the undertakings of the banking companies in the certain cases, which is given in the section 36 AE of the Banking Regulation Act, right? So any bank will be acquired on upon receipt of a report from the Reserve Bank if the central bank is satisfied that a banking company has on more than one occasion failed to comply with the directions which are given to it under section 21 or section 35A, such as relating to the banking policy, all or it is being managed in a manner which is detrimental to the public interest, to the interest of the depositors. If it is in the than that in the interest of the depositors of such banking company, in the interest of the banking policy for better provision, if the central government is satisfied that yes, these reasons are there which are stated, that the bank is not complying with the directions, or they are acting in a manner which is detrimental to the interest of the public, it is against the public interest, then the central government can order for the acquisition, right? So if it is necessary to acquire the undertaking of such banking company, then the central government may, after consultation with the Reserve Bank, they can acquire the undertaking with effect from the date which is specified on behalf again by the central government. So central government is empowered for the acquisition, right? There are also the cases of amalgamation of banks. These amalgamations can be voluntary, or the amalgamation can be by the government, moratorium and amalgamation. So a banking company may be amalgamated with another banking company under the section 44A of the Banking Regulation Act. So voluntary, on their own. For this purpose, again, a scheme has to be prepared. Then this draft will be placed before the shareholders of the two companies separately. It will be approved by a resolution which is passed by the majority of the members, right, representing two-thirds of the value of the shareholders. If it is not approved, then another plan can be presented, or we'll say that the amalgamation can be cancelled or it will be accepted if it is approved, right? Then amalgamation can also be done by the company. So the central government is empowered to order amalgamation of two banking companies. This is under the section 396 of the Companies Act 1956. Again, this decision of the central government has to be in consultation with the Reserve Bank. If we talk about the moratorium and amalgamation, so Reserve Bank is authorized under section 45 of the Banking Regulation Act to apply to the central government an order of moratorium in respect of any banking company where it appears to it that there is good reason to do so. So this may be on the terms and conditions that the government thinks or they prefer to impose. This period of moratorium is extendable from time to time. However, this total period shall not exceed 6 months. All right, this total period shall not exceed 6 months. In this period, what is the period of moratorium? The banking company shall not make any payment to the depositors, or they shall not discharge any liabilities or obligations to any other creditors unless it is otherwise directed, right? So this is the period of moratorium. Okay, then again, if the amalgamation is necessary to do so because it is in the interest of public or in the interest of depositors for securing the proper management of the banking company, the decision can be taken. All right. Then what else? Okay. Winding up of banks. The winding up is completely different from amalgamation and mergers. Winding up, right? So a banking company, they need to be able to pay off its debts or to the creditors. It is also required to pay back to its depositors. If for any reason a banking company is unable to meet its liabilities, then it may result in the winding up of the bank. So winding up or liquidation, basically the process of dissolution of a bank, when it ceases to do the business as usual, when it is no longer conducting the banking business. So, a banking company which is temporarily unable to meet its obligations, they may themselves apply to the High Court under Section 37 of the Banking Regulation Act for staying the commencement or continuance of any proceedings against it. The winding up decision is taken by High Court, but if the bank says that it is only a temporary thing, that we are not able to perform our duties, then the High Court may consider the reasons that are provided. All right. So, if the High Court thinks fit, subject to any terms and conditions, the fixed period may be applied. Right. Again, this total period will come under the moratorium. It will not exceed 6 months. If we talk about the winding up of the by the High Court, winding up of the banking company by the High Court. So, the High Court shall order the winding up of a banking company, which is given in Section 38 of the Banking Regulation Act. If the banking company is unable to pay its debts, or an application for the winding up has been made by Reserve Bank under Section 37 or Section 38 of the Act, right? And the Reserve Bank is bound to make an application for the winding up under Section 38 if it is directed by the central government. They may issue such direction on consideration of any report or inspection or scrutiny which is made by the Reserve Bank, right? But before giving any such direction, the banking company has to be given an opportunity to make a representation. Like they should be given a chance to prove or to be heard, right? Again, it is open to Reserve Bank. They can apply for the winding up if they see there's a failure to comply with the requirements regarding the minimum paid up capital and reserves, or the bank is not able to carry on the banking business. They can be prohibited to accept fresh deposits, failure to comply with the requirements, anything at all, right? If there's a compromise or arrangement sanctioned, or return statements informations show that the banks cannot pay its debts, then the Reserve Bank may decide for the winding up. If we talk about the official liquidator, so we know that the decision of the dissolution is given by the High Court, but at the High Court there should be an official liquidator. This is given under the Section 38A of the Banking Regulation Act, that there shall be attached to every High Court a court liquidator, that is to be appointed by whom? By the central government, for the purpose of conducting all the proceedings for the winding up of the banking companies and performing such other duties. So two things. First, every court, every high court shall have an official liquidator, which will be known as the court liquidator, which will be appointed by the central government. All right. So two things are of importance to us. And all right. RBI can also, or others can also be appointed as the official liquidator. If the RBI feels they can apply to the court under the Banking Regulation Act, right? The any other person on their behalf can act as the official liquidator. All these provisions are there, right? Then if we talk about penalties, so certain penalties are given under the RBI Act, other penalties are given under the Banking Regulation Act. So the chapter 5 of the RBI Act deals with the penalty for violation of the act. Various violations are there, like for the failure to produce any books, accounts, or other documents or statements or information which a person is duty bound to make under the act. Then the penalty is up to rupees 1 lakh for each offense, right? Then for continuing offenses, there's a provision of additional 5,000 for each day when the offense continues, right? So if the banking company, they are not making the correct returns or correct information or documents, or they're providing false information, knowing it to be false, or willfully they're omitting to make any material statement, right? Then they're punishable with this fine plus imprisonment up to a period of 3 years. So this fine plus 3 years jail term is prescribed under the RBI Act. Then, if we talk about the penalties under the Banking Regulation Act, so it is given under section 46, right? Like any false statement willfully made in any return, balance sheet, other document which is required, willful omission to make any material statement is also punishable. Again, punishment is up to 3 years imprisonment, and fine which may extend to up to rupees 1 crore or even both. Both fine and imprisonment can be given. So if the person fails to produce any book or information or giving false information, if any deposits that are received by the banking company, they are in contravention of the Banking Regulation Act, or if any other provision like complying with any requirement or carrying out the terms or obligations, right? Again, when we'll study about these penalties in detail, so under section 47, the offences are cognizable only by the metropolitan magistrate, the judicial first class, or a court superior, right? All of these provisions are given. And today we are going to summarize the unit 5 of module A, which is the public sector banks, private sector banks, regional rural banks, differentiated banks, cooperative banks, and the local area banks. So this particular unit, it basically talks about the different types of credit institutions, and then what are the special laws governing these particular banks, the applicability of the Banking Regulation Act, the RBI Act, the extent of legal control about the differentiated banks, the reason why they have been set up. We are going to cover all of these topics. Now, without further ado, let us start with the session. All right. So first we have the State Bank of India. It was established under section 3 of the State Bank of India Act of 1955. So this is the first important part. What was the reason for taking over the undertaking of the Imperial Bank? So earlier the Imperial Bank was in existence, and then the State Bank was set up, and to carry on the business of banking, other business in accordance with the Act. It is a body corporate with perpetual succession, common seal, and shall sue and be sued in its name. Moreover, the majority of shares are held by the Government of India. So these are the important details about the State Bank of India, set up in 1955 under the State Bank of India Act 1955. If we talk about the management, so it has its central office, which is also known as the corporate center, where in Mumbai. Then the local head offices are at Mumbai, Kolkata, Chennai, and other places which are decided by the central government. And this has to be in consultation with the central board of the State Bank. Other basic information that we already know about the State Bank, it had earlier different subsidiaries which were later on merged with the State Bank of India. The subsidiary banks, there were 7 subsidiary banks of SBI, the State Bank of Saurashtra, State Bank of Indore, which were earlier merged with SBI, right? Then the other banks, merger of the 5 associate banks like the Bharatiya Mahila Bank with SBI, then the State Bank of Bikaner and Jaipur, State Bank of Hyderabad, State Bank of Travancore, Mysore, and Patiala, right? All these subsidiaries, they were merged later on when in 2017. So these are the basic details if we talk about the business of State Bank. So it acts as an agent of the RBI at the places where it has a branch. And if RBI has no branch, then for transacting the government business and other business which are interested to it. So this is the main role of the state bank. Again, if we talk about the accounts and audit, accordingly, it has to close its books and balance accounts each year as on 31st March or any date that is specified by the central government. These are the basic information, the details about the state bank. And the central government is also empowered to make rules under the section 49 of the act to give effect for the purpose of the particular act, right? So the state bank. Then we have the regional rural banks. Herein, Section 3 of the Act authorizes the central government to establish the regional rural banks, and it has to be established by notification in the official gazette. We know that the regional rural banks are started or they are sponsored. So, this setting up of the regional rural banks will be at the request of a sponsor bank to operate within specified local limits. This sponsor bank is a bank by which a regional rural bank is sponsored, and it holds 35% of the issued capital. Very important point. The sponsor bank, which is sponsoring the regional rural bank, the RRB, is going to hold 35% of the issued capital, while 50% is held by the central government and the remaining 15% is held by the state government. So we have the shareholding of 35% by the sponsor bank, then 50% by the central government and 15% by the state government. All right. And what all business will be done by the RRBs is defined in Section 5B of the Banking Regulation Act, and any other business which is permissible to be undertaken under section 6 subsection 1. All right. So in the year 1975, the RRBs were first set up, and the Regional Rural Bank Act, later on the ordinance was replaced by this act in 1976. Then this was basically so that more credit services can be provided in the rural areas for the purpose of agriculture, trade, commerce, industry, particularly catering to the rural population, the small and marginal farmers, the agricultural laborers, artisans, and the small entrepreneurs, right? Again, every RRB is a body corporate with perpetual succession. It also has a common seal. They have the power to acquire, hold, and dispose of the property, right? If we talk about the management, so the management vests in the board of directors, and this board of directors empowered to make regulations so that the provisions of the act can be given effect to. NABARD, the sponsor bank, they have to, with in consultation with NABARD and central government, the board will appoint a chairperson. Okay, if we talk about the business, basically granting of loans and advances to the small and marginal farmers, the agricultural laborers, the agricultural marketing societies, artisans, self-help groups, all of these things are there, right? Now, we also talk about the amalgamation of the RRBs. Two or more RRBs can be amalgamated by whom? By the central government, right? And an ongoing process of the amalgamations and consolidations is in process. 25 RRBs were amalgamated into 10 when in the year 2013. Then 2016 saw amalgamations so that more RRBs were reduced. So this is happening. All right. If we then talk about the other public sector banks other than the State Bank of India, so these are known as the nationalized banks. Why? Because they came into being consequent to the enactment of the Banking Companies Acquisition and Transfer of Undertakings Act 1970 and the Banking Companies Acquisition and Transfer of Undertaking Act 1980. Right? These two acts together are known as the Bank Nationalization Acts. Very important. Which two acts are known as the Bank Nationalization Act? The acts of 1970 and 1980, the Banking Companies Acts. right? Before that, many banks were in existence, but because of the increasing NPAs, the requirement for more supervision and regulation, these two acts came into force, right? And obviously, in the beginning, these banks were held by the central government, but then most of the banks, they subsequently became listed banks after embarking on the public concerns, the public issues, right? Then we have other banks like the banking companies, the Financial Institution Laws Act of 2006, which empower the banks, they can raise their own capital. If we talk about the constitution, so these two acts govern the constitution. For the control and management, each nationalized bank has a board who is going to see the general superintendence, direction and management of affairs. So this board consists of directors who could be either nominated or appointed by the government of India, or it can be elected from among the shareholders. So this board plays a very important role, right? Then if we talk about the schemes of the meetings, so the meeting of the board shall ordinarily be held at least 6 times in a year and at least once in each quarter. Again, very important. When does the board get together for meetings for the discussion of the management directions or any changes that are required? So at least 6 times a year the meeting has to be conducted, and at least once in each quarter, right? So again, the in terms of section 13 and 13A of the Nationalized Banks Management and Miscellaneous Provision Scheme of the 1970-1980, two main committees of the board are the Management Committee and the Credit Approval Committee. Again, very important. This nationalized banks management and miscellaneous provisions of 1970 and 1980. Basically, this scheme provides in detail the constitution of the board of directors, the process for the appointment of the chairman, the managing director, the term of the office, and so on. And it says that two main departments or two main bodies will be there: the management committee and the credit approval committee, right? So this is important. Then certain amendments were made, certain changes were made, and the changes included the members of the parliament, state legislature and the local governments are no longer eligible to be the members of the public sector bank boards. Then the declaration and undertaking that is to be made by the director, it has been made more exhaustive. So these changes were there that later on came. Next, we have the application of the Banking Regulation Act, wherein the Banking Regulation Act can be applied. So this is talked in section 51 of the Banking Regulation Act. This section, very important section, lists those sections of the act which would be applicable to SBI, nationalized banks and the regional rural banks. However, the other sections are not applicable since there are sections in the SBI Act, the Nationalization Acts, which may modify or override. So these sections that are mentioned in section 51, they will be always applicable to SBI and all the other nationalized banks as well as the RRBs. Apart from that, other sections are not applicable because the SBI Act or the Nationalization Acts already have their own sections regarding the particular purpose or the particular issue. So the applicable sections and the matters like section 10, which talks about the prohibition of employment of the managing agents, then restrictions on certain forms of employment. Then section 13 to 15 talks about the restriction on commission, brokerage, discount on the sale of shares, or prohibition of charge on unpaid capital. 17 talks about the reserve fund. So just go through these sections one, right? Here we are only having the summary, that is why we are not going in detail, but just go through them one, which all sections are there which are applicable. All right. Then another important topic is the disinvestment of shares by the government. Recently, we saw the amalgamations, mergers and disinvestments of the public sector banks, right? So the Banking Companies Act and the amendments that were made in 1994, 1995. Various changes were made, like the authorized capital, the shares in which it was divided, right? What was the reason why merger and acquisition take place? So for the low level of capital or the high level of NPAs prevailing, the poor profitability for the entire sector, the low growth rate for the entire sector, various reasons were there or there are, because of which mergers take place. The mega merger of these public sector banks was seen in 2020. We already know this. The Oriental Bank of Commerce and the United Bank of India were merged into the PNB. Then the Syndicate Bank was merged into the Canara Bank. Allahabad Bank was merged with the Indian Bank. The Andhra Bank and Corporation Bank were merged with the Union Bank of India. And Vijaya Bank and Dena Bank were merged with the Bank of Baroda. So this was the merger, the different banks that were merged under the 1st April 2020 merger step, right? So also more privatization or private banks are being given impetus. That is also a reason. Next, we talk about the cooperative banks. So these cooperative banks, which were again set up for more financial inclusion, right? So these are registered either under the state laws governing the cooperatives or under the Multi-State Cooperative Societies Act. So when or how do we make this differentiation? Whether a cooperative bank will be registered under the state law or under the Multi-State Cooperative Societies Act. So if a cooperative bank is operating only in one state, then the state law applies. And if the cooperative bank is operating in more than one state, then the Central Act applies. So in one state, the State Act, and if in more than one state, then the Central Act is going to apply. Also, the Banking Regulation Act is applicable to the cooperative society. So very important, the Banking Regulation Act, the various provisions are going to apply on the cooperative societies as well. But it is subject to certain modifications which are given in Part 5, Section 56 of the Act. Again, no cooperative society other than a cooperative bank is permitted to use as a part of its name or in connection with the business the words bank, banker and banking. So these are the provisions related to the cooperative banks, right? Then the what are the primary eligibility or what criteria should it satisfy for a cooperative bank or a cooperative society? First, the primary object or the principal business is in the transaction of banking business. Then the paid up share capital should not be less than rupees 1 lakh. Then the bylaws, they do not permit admission of any other cooperative society as a member, right? Also, a state cooperative bank is the principal cooperative society in the state, and so central cooperative bank is the principal cooperative society in the district. So these are the basic things for the cooperative bank. We have already discussed the paid up capital and the reserves. There are also cooperative banks. They are required to maintain the cash reserves, like the balance in the current account with RBI or the state cooperative bank of the state which is concerned, or the district cooperative bank. So they're also required to maintain the cash reserves. There are certain restrictions on the loans and advances. This is given in section 20. So section 20 of the Banking Regulation Act lays down certain restrictions on the loans and advances by the cooperative banks. What are these restrictions? Like the loans and advances on the security of its own shares is not allowed, or unsecured loans or advances to any of its directors is not allowed. Then um, these unsecured loans or advances to any company in which the chairman of the cooperative bank is having a substantial interest is not allowed, right? Also, every cooperative bank will have to submit a return in the prescribed form showing all the unsecured loans and advances which are granted by it to companies where the directors are acting, they have substantial interest, right? So all of these things are there. Then the Banking Regulation Amendment Act has replaced the Banking Regulation Amendment Ordinance in 2020, which was approved by the Union Cabinet to bring down 1,482 urban and 58 multi-state cooperative banks under the supervision of the central bank. Now, most of the cooperative banks, the urban and the multi-state cooperative banks, are now under the supervision of the central government. All right. So this is the Banking Regulation Amendment Act of 2020. So it allowed RBI to initiate a scheme for the reconstruction or amalgamation, right? So these are the things. Next, we have the private sector banks. The most important thing is that the private sector banks are classified into the old private sector banks and the new private sector banks. We already know the year of difference. Before that, these banks, the private sector banks, are incorporated under the Companies Act of 1956, or which has been substituted by the Companies Act of 2013. And other old statutes, other acts like the Banking Regulation Act, RBI Act, they also prevail, right? So the private sector banks can be classified into the old private sector banks which came into existence before 1968, and after 1968 the new private sector banks, these were incorporated after the 1990s. All right, so before 1968 old, and in the 1990s, after the 1990s, new private sector banks. As of now, there are 21 private sector banks in India. All right. So, the Companies Act is there. Many of the private sector banks, they have thrived because of the baggage, and of course, they cater to the unique clientele, right? So, these are the things. Then we have the differentiated banks. This concept was first discussed in 2007, wherein the urban cooperative banks, the primary agricultural credit societies, RRBs, and the local area banks, they were existing way before 2007, right? The RRBs, which were set up in 1975, LABs, PACs, cooperative banks, they were in existence. But officially, the concept of differentiated banks was discussed when in 2007. After 2007, the concept or the name was once again discussed and defined properly, formally in a paper, which is the banking structure in India, the way forward. So it was brought out by RBI when in August 2013, right? So first time discussed in 2007. Formally, this concept was, we can say, conceptualized in this particular paper of 2013. All right, so this paper looked into various aspects like the licensing of banks, the banking models, and a transition path to differentiated banks. More emphasis was given by a very important committee that was asked in the previous year paper as well, the Nachiket More Committee. The Nachiket More Committee, right? On the comprehensive financial services for the small businesses and the low income households. So again, the differentiated banks are that are operating in the country, either they can be horizontally differentiated or vertically differentiated based on the basic functions that are performed, the payments, deposits, and the credit, right? And there are definitely many advantages of the differentiated banks, like the diverse opportunities, the huge potential in the big ticket long term infrastructure lending, right? Even in the low ticket unsecured credit, the risk management methodology, the cost control, all of these things are there in the differentiated banks, right? Then under the differentiated banks, we have the payment banks, which the payment banks were initially restricted to holding a maximum balance of 1 lakh per individual customer, but now it has been increased. The maximum balance holding limit per individual has undergone revision to rupees 2 lakh only when in 2021. So payment banks is a type of a differentiated banks, and the existing non-bank prepaid payment instrument issuers and any other entities like professionals, NBFCs, cooperative business correspondents, they may set up the payment banks. Any promoter or promoter group can also have a joint venture with the existing scheduled commercial banks. They can also set up a payment bank, right? If they are fit and proper, then the promoter or promoter groups can set up the payment banks. And again, the activities are acceptance of demand deposits, issuance of ATM or debit cards, payment and remittance services, banking correspondent, distribution of non-risk sharing products like mutual fund and insurance products, and so on. Right? So these are the activities which are performed. The minimum paid up equity capital will be rupees 100 crore, and these are the various details, right? Then we also have the small finance banks, which can be opened by resident individuals or professionals that have 10 years of experience in banking and finance, and companies and societies owned and controlled by residents will be eligible to set up the small finance banks. Scope will be the basic banking activities of acceptance of deposits, lending to the unserved and underserved sections. Capital requirement will be same, rupees 100 crores. The promoter's contribution is fixed, at least 40%, right? So these are the various details. Then we also have the local area banks. The local area banks, whose operation is usually restricted to a maximum of 3 geographically contiguous districts. So it is operating in a limited area. That is why the term local area banks, right? And these are basically focused on the local customers, predominantly in the rural and the semi-urban areas, to bridge the credit gap in these areas. However, with the emergence of the differentiated banks, the local area banks are now not that active, right? Earlier they were working in the non-farm sector, trading activities, MSMEs, and so on. But these banks, pursuant with the announcement of the scheme in 1996, RBI had received some more than 200 applications, but most of them were rejected. And even today, only two are in existence out of the 10 that were initially accepted. These two that are in existence are the Coastal Local Area Bank Limited, which was established in 27th December 1999. Its area of operation includes the three contiguous districts of Krishna, Guntur, and West Godavari, and its head office is located in Vijayawada in the Andhra Pradesh state. Then second is the Krishna Bhim Samruddhi Local Area Bank, which was established in 28th February 2001. The area in which it is operating is the districts of Mehboob Nagar in Andhra Pradesh, Raichur and Gulbarg in the state of Karnataka. Head office at Mehboob Nagar in Andhra Pradesh. So only two local area banks are operating today. This is the unit 6 of module A of our BRBL paper for the CAIIB Foundation, July 2025. And today we are going to start with the unit 6, which is non-banking financial companies or NBFCs. Now let us start with today's chapter, which is the non-banking financial companies. So NBFCs, you already know, play a very important role in the rural credit and credit mobilization, right? The various activities with the NBFCs, they're allowed to engage in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, or activities they cannot, the activities that they cannot transact, right? So now let us start. Let us start with the first point. Okay, so if we see the registration of NBFCs, so NBFCs is a company. A non-banking financial company is a company registered under the Companies Act of 1956 or 2013. And like I just told you, the various activities engaged in the business of loans and advances, acquisition of shares, stocks, or issues, the securities which are issued by the government or local authority, or other marketable securities, right? but it will not include the institution where the principal business is that of an agricultural activity or industrial activity, but direct purchase or sale of goods other than securities, or for the sale, purchase, construction of immovable property. So only in the banking business this NBFC is involved and registered under the Companies Act, right? Next, if we talk about the supervision, so the Department of Non-Banking Supervision of RBI. This department, DNBS, is under RBI. It is entrusted with the responsibility of regulation and supervision of NBFCs under the chapter 3B and C and chapter 5 of the RBI Act of 1934. So this is an important point, under whose regulation or under whose supervision the NBFCs work. So it is a department created under the RBI. So indirectly, RBI has the power of regulation and supervision of NBFCs, under which chapters 3B and C and chapter 5. Now, another important thing is that in terms of section 45, 1A of the RBI Act, it is mandatory that every NBFC should be registered with RBI. Before the NBFC, they want to carry on any business of the non-banking financial institution, first they need to get registered with RBI. So RBI is going to see the various norms and guidelines, whether they are working according to that, do they have the minimum paid up capital or other requirements, and then RBI is going to grant the license of NBFC. All right. Then if we talk about the various activities of or role of NBFC, so NBFC has a very important role in promoting the inclusive growth, right? Then it gives out credit to the MSMEs, the microfinance institutions. They give access to basic financial services like loans, savings, money transfer, monetization of gold, like gold loans are also provided against gold jewelry. Although banks also provide that, but NBFCs, they have shown better or phenomenal growth, we will say, as compared to the bank, because of their simplified sanction process, quick loan disbursement. It also provides second-hand vehicle financing, affordable housing. So it helps in many ways for financial inclusion, for helping the weaker section of the society. And we have already seen the registration of the RBI, of the NBFCs under RBI. Now there's an amendment that was made dated September 1, 2016, which issued the regulatory guidelines in respect of NBFCs. This is the NBFC systematically important non-deposit taking company and deposit taking company. So the ND and D, these are two categories of NBFCs, the non-deposit taking NBFC and the deposit taking NBFCs. For all of these categories, certain new guidelines have been issued in 2016, right? So these are applicable. Then the NBFC factor, which are registered with RBI, the infrastructure debt fund, the microfinance institutions, the infrastructure finance companies. These guidelines are applicable on all of these entities. So the guidelines are regarding the requirement of net owned funds and the capital requirements. If we talk about the net owned funds, so the Reserve Bank has specified 200 lakh rupees or rupees 2 crores as the net owned fund which is required for a non-banking financial company for carrying on or commencing on the business of non-banking financial institution. So this is the requirement, rupees 2 crore. So the net owned fund of the NBFC should be how much? Rupees 2 crore. Then if we talk about the capital requirements which are given under the guidelines, first, every applicable NBFC, whether it is a non-deposit, deposit taking, infrastructure debt fund, factor, or it is any other, right? They need to maintain a minimum capital ratio consisting of tier 1 and tier 2 capital, which shall not be less than 15% of its aggregate risk weighted assets. on the balance sheet and off risk adjusted value of balance sheet items. So 15%. 15%. Then if we talk about the tier 1 capital in respect of the NBFCs other than the microfinance institutions or the infrastructure finance company, what is required of them? At any point the capital requirement shall not be less than 10%. All right, it shall not be less than 10%. Finally, for the applicable NBFCs which are primarily engaged in lending against gold jewelry. So if their primary business is giving out loans against gold jewelry, then they shall maintain a minimum tier 1 capital of 12%. So three amendments or three guidelines have been given for the capital requirements. Every applicable NBFCs, they have to maintain 15%. Then other than MFI and the IDF, Infrastructure Debt Fund, 10% for tier 1 capital, and for the NBFCs which are engaged in the loans against gold jewelry as their primary business, they shall maintain the capital requirement of 12%. So these are the capital requirements. Then one very important topic, in fact the most important topic of this chapter, there's a revised scale-based regulatory structure. Now the NBFCs have been divided into 4 layers, which is based on their size, their activity, and their perceived riskiness. Right? So there are 4 layers. We have the base layer, which is at the bottom, then the middle layer, the upper layer, and the top layer. All right, this is the revised scale base. So if you're asked what is the basis for this classification, the NBFCs, they are divided on the basis of their size, activity, and their perceived riskiness or risk taking. So first we have the base layer. The base layer would comprise of the non-deposit taking NBFCs below the asset size of rupees 1000 crore. So the NBFC non-deposit ND that have the asset size of below rupees 1000 crore, they will be included in the base layer. Then the NBFCs which are undertaking the following activities like peer-to-peer lending platform, account aggregator, non-operative financial holding company, and those NBFCs which are not availing public funds and are not having any customer interface. So first we see the size, which is less, below the asset size of 1000 crore. Then we see these activities and also having no customer interface, not availing public funds. So the most less risky business, we'll say. So these are included in the base layer. Then the second layer is the middle layer, which would consist of all the deposit taking NBFCs irrespective of the asset size. The all the NBFCs, deposit taking NBFCs, will be included in the middle layer. Then those non-deposit taking NBFCs with the asset size of rupees 1000 crore and above, less than 1000 crore are included in the base layer, more than 1000 crore are included in the middle layer. Then according to the activities, the standalone primary dealers, the IDF, Infrastructure Debt Fund, core investment companies, the housing finance companies, and the infrastructure finance companies. All of these entities are included in the middle layer. So we need to remember that all the deposit taking NBFCs plus the non-deposit taking NBFCs which have the asset size of more than rupees 1000 crore. Apart from that, if they are undertaking any of these activities, whether they are the primary dealers or the infrastructure debt fund, housing finance companies, all of them will come under the middle layer, right? Then the third layer is upper layer, which would comprise of those NBFCs which are specifically identified by the RBI that require enhanced regulatory requirement based on a set of parameters and scoring methodology as devised by them. So here we will say that they have a higher asset class or they have higher risk taking riskiness. So RBI has put them into the upper layer. So only the top 10 eligible NBFCs in terms of their asset size shall always reside in the upper layer irrespective of any other factor. So the top 10, the highest asset size NBFCs will be kept in the upper layer. Does not matter whether they are the activity in which they are engaged in, whether they are housing finance companies or standalone. If their asset class is in the top 10, then they will be included in the upper layer. And finally, we have the top layer which ideally would remain empty and may be populated if RBI is of the opinion that there is a substantial increase in the potential systematic risk from the specific NBFC. So those NBFCs, the top 10 NBFCs which were kept in the upper layer because they require enhanced regulatory supervision or enhanced regulatory requirement is there, a set of parameters and scoring methodology is being followed. If among those 10 NBFCs, RBI feels that there is even higher level of supervision required, there is increased potential systematic risk, then they will shift, RBI will shift these NBFCs from the upper layer to the top layer. Otherwise, this top layer would ideally remain empty, right? So such NBFC shall move to the top layer from the upper layer. All right, so these are the four layers, these are the four categories of NBFCs. Then one very important topic from this chapter is the co-lending model, the co-lending model. So co-lending model means an agreement which the banks and the NBFCs they enter into, and they post the policies on their website that together the facilities provided by the bank and the facilities provided by the NBFCs. So for this, the banks and the NBFC shall formulate a board approved policy for entering into the co-lending model, right? So they can be entered between the two partner institutions. It will include the terms and conditions of the arrangement, the criteria for selection of the partner institutions, the specific product lines and the areas of operation, along with the provisions related to the responsibilities, customer interface and protection issues. All right, so mandatorily the things, the conditions that will be followed by the banks and that will be followed by the NBFCs will be put in place and it will be approved by the board. All right, so a board approved policy for entering into the co-lending model, wherein everything, all the terms and conditions that will be fulfilled by the two partner institutions will be mentioned. All right, then other topics from this chapter, like what is the bank finance to the residuary NBFCs, or which is also known as the RNBCs, the activities which are not eligible for bank credit, the activities which are undertaken by NBFCs but are not eligible for bank credit, like the bill discounting or rediscounting, investments in the current or long term nature, unsecured loans, all the loans given to subsidiaries, group companies. These are such topics which we will cover in other chapters as well, right? Then, if we talk about the corporate governance, so all the applicable NBFC base layer, they need to have a risk management committee, right? They are going to focus on risk management. Disclosures are need to be made, they are need to be expanded to include the different types of exposure, like related party transactions, the loans to directors. Then, if NBFCs are giving out loans to directors, senior officers, and relatives of the directors, right? For that, where the board approved policy is required as to what should be the quantum, what should be the terms, what should be the regulations. Then, we also need a key managerial personnel, a timeline as to which this managerial person will not hold any other office in any other NBFC in the middle layer or the upper layer. All of these things are there. All right. Then there are certain prudential guidelines which are applicable, like the existing limit of loans investment which is allowed, what is the revised limit or loans, the ceilings of the investment, and the infrastructure finance companies, right? So these are the various topics in this particular chapter that you will come across when you study this. So more detailed discussion, more detailed revision is required, but for a summarized version, these are the important topics, and from the exam point of view, the categorization is the most important as to which types of NBFCs, which categories of NBFCs will be included in which layer among the four layers that have been given. All right. And today we are going to summarize the Unit 7 of Module A, which is the financial sector, legislative reforms, and the Financial Stability and Development Council. Now, when we talk about the financial sector or the financial sector reforms, so prior to the banking sector reforms, there were the Indian banking system was seeing repression, extensive regulation, administered or controlled interest rates, then directed credit programs. Then, in this context, the first Narasimham Committee, the Committee on Financial System, was set up in 1991, and it was followed by the second Narasimham Committee in 1998. So let us discuss the recommendations. So the first committee, the Narasimham 1 Committee in 1991, was set up in August 1991. Why? To examine all the aspects relating to the structure, organization, functions and procedures of the financial system. So this committee was known as the Committee on Financial System. The whole financial system in India, the structure, organization, functions, and procedures, right? This was actually the first systematic attempt by the government of India at reforming the financial system or the banking system. And it submitted its report when in 19 November 1991. In November 1991. Then there were various recommendations given by this committee. It found that the CRR and the SLR are legal reserve ratios that were required to be kept by the bank were very high, aggregating to 53%. So we can see how high these legal reserve ratios were, because of which the lending capacity of the bank was reduced. It led to a continuous loss in the potential income to the banks, which in turn adversely affected their profitability. Alright, so the committee termed the high SLR as a tax on the banking system, and it recommended its lowering. So it suggested that this high 53.5% of the reserves should be reduced, right? Then we also saw it was earlier the banking system had a directed credit program. So the committee was critical of the directed lending to the priority sector, and it felt that insistence on collateral, weak post credit supervision and monitoring had to be corrected. Then it also said that interest subsidy being offered in various schemes was again a loss of precious profits to the banks. It again led to lowering of the profits for the banks. Other findings like opening of large number of branches without considering in many cases and potential viability led to the risky behavior. Then the command and control was too high. It was causing problems. Then deterioration of the staff quality due to rapid recruitment and promotion, excessive bank credit to the agriculture and small industry. Again, it led to lower profits. So these were some of the recommendations regarding the financial sector given by the Narasimham Committee 1. Then the Narasimham Committee 2 was termed as the Committee on the Banking Sector Reforms. The first committee basically talked about the various problems, the reasons for the low profitability of the banking sector. Then the second committee talked about the banking sector reform. So this is one of the most important committees. It was set up when in December 1997 to review the progress, the implementation of the financial sector reforms, which were given by the first Narasimham Committee. All right, and it gave its report. It submitted its report when in 1998. It submitted its report in April 1998. So the various recommendations of the committee were regarding the strengthening of the banking system, the capital adequacy measures, the concept of risk weights, higher risk weights wherever required, CRAR, asset quality norms, then how the NPAs have to be treated, interest subsidy, asset reconstruction companies. These were the various recommendations given by the Narasimham committee too. Right? Many recommendations have been implemented. They're still in the implementation stage, and it was expected, like the Surface Act, the Basel III norms, that because of this, the financial sector will see a huge improvement. But then, because of the global financial crisis in 2008, which India had fairly dealt with well, but it was realized that these financial sector reforms had to keep going. It is an ongoing process and more constant improvements are required. So the FSLRC, the F Financial Sector Legislative Reforms Commission, which was headed by the Justice B.N. Sri Krishna, was set up by Ministry of Finance when in 2011 to review, simplify and rewrite the legal and institutional structures for the financial sector. And this was again a very important commission. It submitted its reports in March 2013. So the FSLRC was set up to review what all is required. So it gave the remedial measures regarding the banking policy, the institutional structure, supervisory system, legislative and technological changes. So removing of the existing financial repression, creation of a profitable financial sector, price discovery by the market, increasing healthy competition, preparing the financial system for increasing international competition, then monetary policy, banking sector, financial sector. All of these recommendations and all of these remedial measures were given by this commission. Now here if you see the Narasimham committee report on banking sector reforms talked about strengthening of the banking sector, asset quality management, system and methods in banks, structural issues, and technological upgradation. These were some of the important recommendations that were made by the Narasimham committee too. Then, so what all banking sector reforms were given? Competition enhancing measures, measures enhancing the role of market forces, the prudential measures, institutional legal measures, supervisory measures, and the technology related measures. The technology related measures. These are the different financial or banking sector reforms. Banking sector reforms. So if we talk about the competition enhancing measures, so giving more autonomy to the public sector banks, reduction of the public ownership, right? Disinvestment was there seen. Then transparent norms for the entry of Indian private sector, foreign sector and joint venture banks. Then foreign banks, their guidelines, mergers and amalgamation of the private sector banks and the NBFCs, right? Licensing of the banks in the private sector. Then we saw after the nationalization of the 14 large banks in 1969 and then liberalization in 1999, it was felt that private money market could lead to higher efficiency. So private sector banks like HDFC, ICICI, UTI, IDBI and some others were set up, right? Earlier it was felt that nationalization would lead to improvement, but later on the requirement of privatization and private sector banks also arise, right? These were some of the competition enhancing measures. Then second are the measures enhancing the role of market forces. So earlier the interest rates were regulated by RBI, they were fixed, but now deregulation was seen. The market forces determine the a lot of flexibility is given in the interest rates, right? So for this the reserve requirement was sharply reduced. Then interbank call money market, auction based repos, reverse repos, then dematerialization and markets for the securitized assets, the targeted long term operation scheme. Various schemes were launched. There were also certain prudential measures that were taken. Prudential measures like the phased implementation of international best practices and risk weighted capital adequacy requirement norms, accounting, income recognition, measures to strengthen the risk management, KYC, anti money laundering guidelines, introduction of the Basel III guidelines. These were the prudential measures, right? Apart from that, institutional and legal measures were also taken, like setting up of the Lok Adalats, the Surface Act, then the Clearing Corporation of India Limited, CCIL, Credit Information Bureau of India Limited, CIBIL, the IBC code, the Insolvency and Bankruptcy Code, was enacted in 2016. Supervisory measures for better supervision. Various steps were taken by RBI, right? Establishment of the Board for Financial Supervision, for the NBFCs. Then introduction of the CAMELS supervisory rating system, right? Strengthening the corporate governance, ease, enhanced access and service excellence. And finally, technology related measures like setting up of the Infinet, then the Payment and Settlement Systems Act of 2007, RTGS, NEFT, ATMs, mobile banking, internet banking, then use of artificial intelligence, machine learning, robotics, and various other steps were taken and still are being taken for the technology enhancement, right? So these were the banking sector reforms. Then reforms were also taken in the financial markets, right? In the financial markets, like there were the money market reforms, so for providing better opportunity for the market players so that they can access the short term funds. Liberalization methods measures were taken. The interest rate swaps were introduced, forward rate agreements. Then repo market, the scope of repo market was enlarged. So for the repos, what step was taken? With step towards making the call market a pure interbank market. Turnover progressively switched from the call money market to repo and CBLO market. Then a part of the reforms, the concessionary financing was eliminated, and with the introduction of market auction system and phasing out of the automatic monetization. So these were some of the financial market reforms. The financial market reforms. Then regarding the government securities market also, the GSECs, the SDLs, treasury bills, cash management bills, they constitute the government security market. These are auctioned by RBI at scheduled frequency. Also, the primary market witnessed a significant movement away from the controller of capital issues. Because it led to a lot of control, imposing primary issuance of the submarket rates. But now we are moving towards free pricing and book building system along with mandatory disclosures. So these are the financial market reforms. In the capital market also, the many other segments in the capital market also, or we can say in the secondary market, the corporatization of exchanges, screen based trading system replacing the open outcry system, right? Rolling settlement replacing the 14-day settlement cycle. These were the steps that were taken in the financial market. So we have seen the banking reforms and the financial sector reforms. Then certain reforms were also taken in the forex market, like the adoption of managed floating exchange rate system, shifting from the fixed one to a managed. Then rationalization of the structure of the market, introduction of a variety of products such as options and swaps, gradual move towards the capital account convertibility, and infusion of stability in the market. With the LPG reforms, the forex market reforms were also taken, making the Indian banking system more liberalized. So, authorized dealers were permitted to initiate the trading positions. Banks were also permitted to fix the interest rates on the non-resident deposits, right? Then various participants in the foreign exchange market, including the exporters, they can now avail the forward cover, enter into the swap transactions. The foreign institutional investors and the non-resident Indians were also permitted to trade in the exchange traded derivative contracts. They were permitted to the foreign exchange earners, they were permitted to maintain foreign currency accounts, the EEFCs, right? So these were the steps taken in the forex market. Before these reforms, the foreign exchange market was virtually non-existent in India. But now exchange earners, they are seeing more flexibility. Exchange rate is flexible and market determined. Capital account is also effectively convertible for the non-residents. So the forex market saw liberalization measures. Then we have the Financial Sector Development Council. The Financial Sector Development Council was constituted when? In December 2010. Now we have various regulators for the various segments of financial sector like RBI for the commercial banks and NBFCs, SEBI for capital market, IRDAI for the insurance, PFRDA for the pension fund. Now the primary objective of FSDC is to strengthen and institutionalize the mechanism for maintaining financial stability, promoting the financial sector development, and enhancing the internal regulatory coordination. Right? So this internal regulatory coordination, how is it maintained? Because the FSDC brings together the heads of financial sector regulators. Now let us see a very important topic. The chairman of the council is the finance minister, and who are the members of the FSDC? Members include the heads of the financial sector regulators, that is the RBI, SEBI, IRDAI and PFRDA. Then the finance secretary is also a member. The secretaries from the Department of Economic Affairs, Department of Financial Services, Revenue Department and the Ministry of Information Technology (MeitY), the chairman of the IBC, the Insolvency and Bankruptcy Board of India, and the chief economic advisor. This is a very important topic. You should remember who all are the members of the FSDC, of the council, and the chairperson of the council will be the finance minister. All right. One more very important thing, it is not a statutory body. It is not a statutory body. All right. Now, the FSDC was set up in 2010, a body consisting of all the regulators and the Ministry of Finance. It is the highest forum in matters relating to financial stability, and it is chaired by the Union Finance Minister. Now, what are the responsibilities of FSDC? First, to ensure financial stability in India, in the nation. Then the financial sector development, the macro-prudential surveillance of the economy, financial literacy and financial inclusion, and inter-regulatory coordination. These are some of the important responsibilities or functions of this council. Now, the FSDC has certain wings, or we will say the subcommittees or wings of FSDC. First, we have the FSDC subcommittee. FSDC subcommittee. So in terms of functional responsibility, this committee is headed by whom? By the governor of RBI, right? And it meets more often than the full council. The full council, all the members, more often than that, the subcommittee meets, right? And all the members of the FSDC are also the members of the subcommittee. Then we have other wings like the Inter-Regulatory Technical Group. The name suggests the IRTG was set up when? In 2011. The IRTG was set up in 2011, and the name suggests it is the Inter-Regulatory Technical Group, right? So for group, this meets for the financial sector regulators and coordination, providing inputs to the subcommittee for the systematic financial stability. These are the functions. Then we have the technical group on financial inclusion and financial literacy. Again, the name suggests this group works on financial inclusion and financial literacy. It was also set up in 2011, right, for the financial stability, and it has representatives from all the regulators. Then we have the Interregulatory Forum for monitoring the financial conglomerates. Again, the name suggests the financial conglomerates, or FC. So oversight and monitoring. So here this will be this interregulatory forum will act as the lead regulator, right? And it is headed by the deputy governor of RBI. Other regulators are also the member, like the executive directors of RBI, SEBI, IRDAI and PFRDA. Then we have the working group on resolution regime for the financial institutions, right? If any financial institutions, they face any type of disputes, so for their resolution, right? So to examine the existing resolution regime framework for the entire financial sector, identifying the gaps in the national resolution regime, these are the functions. To recommend changes in the legal framework to facilitate the required resolution including cross-border resolutions. Then we have the crisis prevention and monitoring framework, again in situations of crisis, right, in the financial market. So to take necessary steps to mitigate the impact of financial markets as well as the real sector. These are the functions of the CPMF, crisis prevention and monitoring framework. So generally giving policies for taking action on the evolving risk or vulnerabilities in the respective areas. Then we have the macro financial monitoring group, now macro level, discussing the emergent issues, again based on the information which is derived from other areas, the domestic developments, global developments, all of these are the functions. And finally we have the early warning group. The early warning group, it was set up when in 2012, and these regulators, they coordinate the response of the government of India or regulators in the time of a crisis situation. In the time of a crisis situation. So all of these subcommittees, all of these committees under the FSDC, they have their respective roles to play for the financial sector regulation and monitoring.
So that is all for today. We have completed the revision of this module. And now, if you want to join us for the last minute revision, enroll now for the BRBL capsule batch. This batch is available both in bilingual as well as English medium. You are going to get 12 plus hours of live marathon sessions, downloadable class notes for your quick revision, 10 full-length BRBL mock tests that you can access anytime, and the sessions will be during the non-banking hours, so do not miss any of the live classes. This will be the best strategy for your last-minute revision. If you haven't yet subscribed to the channel, so subscribe to the Oliveboard JIB CIB English Medium channel. Like the video, share the video, and on a daily basis, we are bringing these important sessions for you. So I will see you in the next session. Thank you so much and all the best.